You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host, John McEwen. It's the 9th of May, 2022, and in this week's episode, we'll be discussing Associated British Foods, Whitbread, Unilever, Sainsburys, Reckitt Benckiser, and Apple. John, which consumer goods company do you want to start with first?
I'll start with Associated British Foods. The FTSE 100 company, best known for their Primark brand, had their half-year results out last week, with half-year revenue up 28% to £7.9 billion and returning to pre-pandemic levels. Meanwhile, operating profit nearly doubled to £706 million as stores reopened with minimal COVID restrictions. If we break those results down a little further, the retail division saw revenue grow 64% to £3.5 billion to around 2019 levels with the opening of the retail estate. There was some impact from the Omicron variant in the middle of the period in the UK and Ireland, but this has since recovered. The recovery wasn't quite as strong in mainland Europe with some ongoing restrictions. The group has indicated that price rises will be passed on to consumers to help offset cost inflation. Underlying profits for the retail division came in at £414 million compared with £43 million a year earlier. In the grocery division, sales were up 2% to £1.8 billion, with retail volumes returning, which in turn helped offset the supply disruption beleaguering the sector. Despite this, higher costs, particularly in allied bakeries, led operating profits to fall 9% to £175 million. The group plans to increase prices to help mitigate the extra costs. In the sugar division, revenue was up 19%, coming in at £914 million, and operating profit increased 8% to £77 million. However, margins were down slightly with the setup of the Vivergrove plant. Cost inflation was an issue, but offset by higher volumes and cost controls. In the ingredients division, revenue grew 12% to £798 million, with both increased volumes and higher prices, but significant inflation hit margins, sending operating profit down 17% to £63 million. Free cash flow stood at £178 million, compared with an outflow of £642 million last year, and net debt as of the 5th of March 2022 was £1.7 billion, up from £1.4 billion a year ago. ABF Chief Executive George Weston commented, "Inflationary pressures are such that we are unable to offset them all with cost savings, and so Primark will implement selective price increases across some of our autumn and winter stock." An interim dividend of 13.8p was announced alongside the results, and shares were down around 5% on the news. In terms of valuation, Associated British Foods has a market capitalisation of around £12.3 billion and trades at just 11.6 times earnings, compared with a 10-year average of around 20.5. It currently yields around 3%. I mean, I thought these results were broadly what we might expect in the current climate, and more than reflected in that share price of just around 11.5 times earnings. There was a massive recovery in the retail, which, given that Primark was closed and doesn't do online retail, was again to be expected, but it's reassuring that it's now returning to 2019 levels. I think the major concern is that the margins are being eaten up with the inflationary pressures, and at least in the short term is going to impact on the earnings. I would still back Primark in the long term, and probably with a valuation like that, I don't think it would be unreasonable to start a position in Primark, or in ABF, but I think you'd have to expect a bumpy ride for the next couple of years. And it's difficult to, as with everything, it's difficult to know how things will go from sort of a macroeconomic perspective on that. But I think ultimately Primark is a company that it is definitely investable, and at that price could be your entry point. Sam, what are your thoughts on these results and Primark, ABF as a company?
Largely in line with yours. I also note that I thought it is good that they're back at pre-pandemic levels. Again, the price increases are really interesting because I think when Primark's in a position where they're having to increase prices, that probably tells you that inflation's not transitory and it's not going away. Because I think for a retailer like Primark, the last thing they'd want to do is increase prices. I think the valuation is very attractive, especially given that if the US expansion of Primark goes well, that's not really priced in at all, I don't think, at 11.5 times earnings. I also think it's interesting to look at the share price because it's just under, it's at £15.60 a share now. That compares to a 52-week high of just under £24, and it's basically at the 52-week low, like a lot of things at the minute. But 5 years ago, it was actually above £30 a share. So if you'd bought 5 years ago, you'd be down 43%. If you'd bought 3 years ago, you'd be down 37%. If you'd bought 1 year ago, you'd be down 32%. I think it's interesting because it's probably, or it's possibly the cheapest it's ever been since listing in terms of an actual PE perspective. I think it's a very, very good business, and I think it's a very attractive valuation. The question is just whether in this market there's more attractive valuations for other businesses out there. You are spoilt for choice at the minute because everything's just been hammered.
Yeah. Is it one for you?
It's definitely good enough for the watch list. Whether or not it would move from the watch list to start in a position, I don't know. There's a lot of businesses I already own that I'd probably add to first. Like I was saying to you earlier today, like Games Workshop's at 19 times earnings now. We were saying off air, Disney's been cut in half. There is just quality businesses everywhere have just been absolutely slaughtered. But I think you could do a lot worse in Associated British Foods.
And I mean, this is always the difficult question, but do you think we've seen the worst of it, or are you expecting worse to come?
I think it's definitely one of the two.
Okay, great. Let's move on then. Whitbread.
So our favourite hotel chain on the show, they have come out with their full year results, and full year revenue rose from 589 million to 1.7 billion. Beating market expectations and 17.8% down on pre-pandemic levels. There was a strong recovery across the portfolio as the group lapped the previous year, which was heavily impacted by restrictions. Underlying cash profits, EBITDA, improved from a loss of 194.9 million to a profit of 472.6 million, which is down 37.2% on pre-COVID levels. And although the EBITDA may now be showing a profit, I wouldn't get too excited because there's still no earnings. Cost inflation is running higher than expected at around 8 to 9%. However, the group aims to offset this through cost reduction, estate growth, and increased prices. I thought this was quite interesting because I don't see how estate growth actually offsets inflation. I understand you might get more profits that are making up for it, but that doesn't actually improve the margins. Which probably shows what a tricky position they're in, that they're even saying that. Total UK sales, which make up 98% of total sales, rose from 577.4 million to 1.7 billion. But like-for-like sales were 23.5% down on pre-pandemic levels. Premier Inn UK continued to be impacted by restrictions in the first quarter, but saw a strong recovery from the second quarter on. In the second half of the year, UK total sales marginally exceeded pre-pandemic levels as accommodation sales were 7.9% ahead. Occupancy for the year was 68.3% compared to 76.3% pre-pandemic, with an average room rate of £56.67, which was down 7.9%. The division reported underlying cash profits of 489.8 million. In Germany, the group reported sales of 35.2 million, up from 11.8 million pre-pandemic. This reflects new hotel openings, which have gone from 6 to 35 over the period. Occupancy fell from 58.3% pre-pandemic to 40.7%, which with average room rates of £40.53 compared to £69.47 pre-pandemic. The region reported underlying cash profits of 13.7 million. Whitbread has committed to adding 8,332 new rooms in the UK and 8,454 in Germany. Free cash flow in the half came in at 308.3 million, a significant improvement on the 608.5 million outflow last year, reflecting increased profits. The group finished the half with net cash of 140.5 million, excluding lease liabilities of 3.4 billion. This compares to net debt of 46.5 million a year ago, excluding 3.2 billion of lease liabilities. The prospective dividend yield in the next 12 months is 1.4%, and the price to book is 1.45 compared to a 5-year average of 1.66. As mentioned before, there are no earnings. If we look at the share price, the shares are currently trading at £25.67. That's not too far above the 52-week low, but it's quite a bit below the 52-week high of £34.65. Over 3 years, the shares are down 30.89%. John, your thoughts on these results and Whitbread as a company?
So I think on the face of it, some of the results are encouraging, particularly in the second half, where accommodation sales in the UK were 12.5% or ahead of the pre-pandemic levels, and 7.5% on a like-for-like basis, with revenues up 189%. I think it's also pleasing to see that it outperformed its economy rivals by nearly 15% so far this year. But I think there are a long list of far better businesses out there that are profitable that I'd look at before coming to Whitbread. So not one for me.
What do you think of the Germany expansion? Because that's big, that another 8,000 rooms, because it is tiny at the minute, Germany.
I think it's interesting. It definitely, in the economy sector, it's a strong brand. I don't know much about Germany, but if it is anything like the UK market, then that could in the long run be good for Whitbread. But I don't know enough about it. I don't know enough about the competitors over there as well.
No, I don't know anything about the competition over there.
Right.
I agree with you.
Nothing.
Yeah, I agree with you there in terms of there being better businesses. Because I mean, we'll sit down like a third from its high, from the 52-week high. That's so, you know, if it goes back to that, you got 50%. But like we were saying before, when you could have Associated British Foods, which is down probably more from its 52-week high. I mean, Associated British Foods is the better business with probably less risk. And it's got further to climb to get back to where it was. So I think
it's
very
a
different
long list.
Yeah, but very different companies. But just taking those two, for me, it's a no-brainer. I'd go with Associated British Foods. I don't think the shares are at enough of a discount to justify the risk. And also as well, I think even when they are back at pre-pandemic levels, I don't feel like it was the best business in the world pre-pandemic.
No, quite.
Right.
They do have a good shareholder perk, though. I think if you own, when I looked at it last, maybe about £5,000 worth of shares. I'd have to check this. You do get free Premier Inn breakfasts. You might buy it for that reason.
Okay, well, there's a top tip. You don't get that anywhere else.
No, exactly. A better business, Unilever, favorite of the show, the FTSE 100 consumer goods company, owner of Dove, Ben & Jerry's, Lynx deodorants, had their first quarter results out last week, with sales adjusted for the impact of exchange rates up 7.3% to 13.8 billion euros and ahead of market expectations. This was largely down to an 8.3% increase in prices, which in turn led to a 1% decline in volumes. If we break this down by division, then beauty and personal care saw sales rise 7.1% to 5.7 billion euros, with prices up 7.4% and volumes down 0.3%. Prestige beauty, Hourglass, and Living Proof all performed strongly with premium hair and makeup, while skin cleansing was more muted with high single-digit growth. In home care, sales were up 9.2% to 3 billion euros, with a 12.5% hike in prices, which more than offset the 2.9% hit in volumes. Home and hygiene also grew, again with price rises offsetting volume declines. In food and refreshment, sales were up 6.5% to 5.1 billion euros, with prices up 7.1% and volumes falling 0.6%. Plant-based foods and a vegan month in Europe boosted Knorr and the Magnum Remix range. Free cash flow came in at just under the 6 billion euro mark, and net debt was around 2.2 times EBITDA. Along with the results, it's worth noting that Unilever is planning to reorganize the 5 business categories from the middle of the year, with expected cost savings of around 600 million euros in the next 2 years. Moreover, the long-awaited sale of the tea business is also expected to be completed in the second half of the year. The group say that they expect inflation to increase costs by 2.1 billion euros in the first half and 2.7 billion euros in the second half. Revenue growth the first half is expected to be in the region of 4.5% to 4.6%, with operating margins under pressure at around 16 to 17%, with inflation biting. The group have completed a 750 million euro of the 300 billion euro share buyback and have confirmed a further dividend of 42 cents for the quarter. In terms of valuation, Unilever has a market capitalisation of £93 billion and trades at 17 times earnings, which compares with a 10-year average of around 19 times earnings, and the shares currently yield around 4%. And as I've said many times before, I like Unilever, I love its brands, even if they have underperformed the peers like Nestle and Procter & Gamble. I think the current inflationary environment is obviously a concern, particularly as the price increases are knocking the volumes, and that's not something that you'd want to continue to see, nor is the declining margins into the mid-teens. And I think that's probably reflected in the share price. It may not be a bad time to get into Unilever at the current price. I appreciate it's certainly not cheap at 17 times earnings. But if you're optimistic, if they shape the business, get the house in order a bit more with Unilever, those brands perform. And if we see inflation reducing over the next year or two, then I think it's reasonable, and it's a business that you would hold for the long term. So I still like Unilever. It could be performing better. It is cheaper than its peers like P&G and Nestle as a result. So yeah, it's one that I still like, but those concerns aside,
I think these are quite decent results, actually. I think they're the best we've seen in a while. I mean, last time we covered them, I think we were saying, I don't know why they've not put the prices up more, because I think they could. And then now we've seen the sales are up 7.3%, and that's basically driven by 8.3% increase in prices. I think they're better than the Reckitt results we'll cover later on. I think it's just nice to see them actually do something. These are, I think the last few times we've covered them, I've been a bit more disappointed. I think the growth's been more lackluster. I appreciate that 7.3% looks more impressive than it is, because if you back out inflation, it's probably in line with previous levels. But I'm probably pleasantly surprised by that. I don't know how I feel about the. Sorry. Yeah,
I was going to say, coming on to the volumes, what does that? Is that a longer term concern? Because obviously you can temporarily, increase prices, and that's going to offset. But do you think that's going to have, if we see a longer inflationary period, that is really going to start impacting if you see volumes beginning to fall?
I don't know is the answer, but at the minute, I think if you can up your prices by 8.3%, and that only causes a 1% decline in volumes, it's clearly, to me, it's clearly the right decision. How do you feel about the buyback?
I think there could be better uses of the money. We have discussed it before. I'd rather see it reinvested into the brands, to be honest, or
that's what I was thinking.
Maybe the acquisition of a younger growing brand, a bit like with Diageo, where we've seen them do that really well.
Yeah, because I suppose if they are going to be buying back shares, now is a good time to do it, because it's pretty cheap at the minute. But I agree with you. I think when the performance has been so lackluster over the last few years, surely there's better ways to spend 3 billion.
Yeah, absolutely.
But I think these results are fairly encouraging, actually, especially compared to the last ones, which I wasn't impressed with.
Would you be buying Unilever now, adding it to the watch list?
It's definitely good enough for the watch list. It's probably for me. There's probably better businesses out there at 17 times earnings, I think.
Fine. Okay, good. On to the next company.
Yes. So Sainsburys have come out with their full year results, and full year sales, excluding fuel, were down 2.6% to 28.1 billion. And for context, we covered Tesco's full year results fairly recently. And excluding fuel, they were up 3%. So these are notably worse. So Sainsbury's minus 2.6%, Tesco's up 3%. Grocery sales were broadly flat, and an increase in clothing couldn't offset the fall in general merchandise as sales continued to normalise. Benefiting from lower COVID-related costs, group underlying profit increased 46% to 1 billion. The group warned of significant external pressures and uncertainties, putting pressure on full-year underlying profit, which is expected to be between 630 to 690 million. Fuel sales increased by 60% to 4.8 billion due to higher oil prices and increased traffic volumes. Supermarket sales fell 2%, having risen 11.4% the previous year, within which online grocery sales fell 4.7%, following the 120% increase the prior year. A recovery in footfall to urban areas meant convenience store sales increased 8.8%. Grocery sales fell 0.2% to 21 billion. The group's value proposition performed well with campaigns such as Aldi Price Match and raised prices behind the market on high volume products. General merchandise sales fell 11.9% to 6.1 billion as the group lapped a prior year where sales were boosted by lockdown purchases. Supply chain challenges also weighed on the group's ability to service demand over the year. Full price sales and higher in-store sales helped clothing sales rise 12.7% to 1 billion, following a year of suppressed demand due to restrictions. The total Sainsbury's store estate shrunk to 1,407 stores from 1,411 stores in March 2021. During the period, 73 standalone Argos stores closed and 64 opened within Sainsbury's stores. As at 5 March 2022, Argos had 728 stores, including 400 stores in Sainsbury's. The standalone Argos store estate is expected to fall to around 100 by March 2024. Financial services posted an underlying operating profit of 38 million from a loss of 21 million the year before. That comes as credit provisions were lowered and some COVID-related bad debt provisions were released. An increase in net interest margin from 3.5 to 4.5% also helped. Retail free cash flow decreased by 281 million to 503 million, as some of the working capital benefits seen last year unwound. Net debt, including leases, increased from 6.5 billion to 6.8 billion due to the lower free cash flow. At the end of the period, the ratio of net debt to cash profits was 3.1 times, which I think is probably fairly manageable. In terms of the valuation, the business trades at a P ratio of 10.5, and that compares to a 10-year average of 14, and the prospective dividend yield over the next 12 months is 5%. I think this is a business at a fairly attractive valuation. I don't know how I feel about Argos. I don't really like it. I just think this isn't as good a business as Tesco, and that's shown in the results pretty much every time we look at it. John, what are your thoughts on these results in Sainsbury's as a business?
It's similar. I think if I were choosing something in the sector, it would definitely be Tesco's. And it's difficult also, I think, to see where Sainsbury's sort of sits in terms of, you've got companies like Waitrose, you've got Tesco's, and I think Tesco's is really, it's the middle ground, but it has value, and it also does its sort of more premium ranges. And it's got a very good integrated supply chain. And I just don't see how Sainsbury's sort of competes on any level with Tesco's as a business. And I suppose with this inflationary environment, Tesco's is better placed to handle it than Sainsbury's is. So it's not one that it's not one that I'd really consider at all. And I think that the supermarkets, as we've said when we've covered Tesco's before, are just going to have to sort of soak it up. They're probably not going to be able to increase their prices like they tried to do in 2008 because of the German discounters.
I think Sainsbury's has a problem as well. If it were to try and increase prices, it just doesn't have the scale that Tesco has. I know it's big, but it's not as big as Tesco.
Yeah.
And that's difficult because it makes it much harder to go up against the Aldis and the Lidls. So where they've got where did it mention it before? It said they'd run the campaign where it was Aldi Price Match. That will hurt them a lot more. I know they need to do it, but it'll hurt them a lot more doing it than it would for Tesco doing the same thing.
Yeah, absolutely.
But yeah, I think it's just a worse business than Tesco. It doesn't mean it's a terrible business, but I just always rather own Tesco. If the valuations were the same, you'd pick Tesco every time.
Yeah, no, completely agree.
Right.
Okay, Reckitt, and it's the second biggest consumer goods company on the FTSE 100, also with their first quarter results out last week, which showed net revenue up 5.6% to £3.4 billion, largely as a result of price increases and a modest volume growth of 0.3%. In the hygiene division, net revenue was down 9% to £1.5 billion, with volumes falling 12.8%, but price mix had a positive impact of 3.8%. As might be expected with the easing of the pandemic, Lysol sales fell 30%. However, Finish, Air Wick and Vanish all grew revenues. In health, volumes grew 15.5% and price mix grew 5.1%, boosting net revenue 20.6% to £1.4 billion, with the return of the cough and cold season helping Mucinex and Strepsils. Unsurprisingly, Dettol sales fell against tough comparators, but are still ahead of 2019 levels. In the nutrition division, net revenue was up 20.4% to £557 million, with volumes up 8.9% and price mix 11.5%. Furthermore, the infant child nutrition business grew net revenue by 30% in the US, gaining market share, but total net revenue was down 36.5% with the disposal of the infant child nutrition business in China and Baby in Argentina. Like-for-like net revenue growth is now guided to be toward the top end of the 1 to 4% guidance issued previously, but the group cautions about significant cost inflation in the high teens. Reckitt still expects operating margins to be in line with the previous year, and shares were up around 2% on the news. In terms of valuation, Reckitt has a market capitalisation of around £45 billion and trades at 20 times earnings, which is broadly in line with its 10-year average, and it yields just under 3%. I mean, you alluded to it earlier, Sam, but I think there were good results from Reckitt, not as good as Unilever, although overall volumes did grow slightly, but it was passing on, or I suppose price increases that it was driven by. Some of the things that you kind of expected with Reckitt, because it had that exposure to brands like Dettol, which were boosted exponentially over the COVID period, and now are returning to normal, but are still slightly better than they were pre-pandemic. So that is something that's good. But the cough and cold season returning, obviously good for business. Durex doing well. I think the brands of Reckitt aren't quite as strong as Unilever, but I think it's the same long-term argument for Reckitt, and ultimately it's going to sort of the sales of its products in the emerging markets. Obviously, they had the unsuccessful acquisition and now disposal of the infant child nutrition business in China. Hopefully, it'll be a business that's in better shape as a result of that disposal, and they can reinvest the money in some of the higher growth brands. But I don't think they were bad results. I think Reckitt is still a very decent company. Probably at current prices, if I was to choose between Reckitt or Unilever, I'd definitely be choosing Unilever. It is that bit cheaper and probably overall a better company, but I like both. What are your thoughts on Reckitt? Is it one that you'd invest in at current prices, or one even for the watch list?
I mean, I think in terms of just purely comparing the brands, I prefer Unilever's. I do think there's some bias there in that Reckitt's is more like cleaning sort of brands and stuff like that, whereas obviously Unilever's got like a lot of stuff that I actually use a lot more, and a lot more stuff that I eat too, which is probably partly why I prefer the brands. But I just think it's difficult because Unilever does have better results, but I think if we were to look at the past 2 years as a whole, Reckitt's done much better than Unilever in terms of the performance. But this quarter, Unilever does have better results. I think the protective yield of 2.8% is pretty good, but I just think to pay a forward PE of 20 I'd be a bit uncomfortable with that, especially if I could get Unilever for 17 with a higher dividend yield. But it is a very good business.
Good. On to perhaps the highest quality, well, almost certainly the highest quality business of the week, our US company, Apple.
Yes, probably one of the highest quality businesses in the world, actually, you can make an argument for.
Definition of quality.
Yeah, they've come out with their Q2 results, and all these figures will be in dollars. Total net sales rose 8.6% to 97.3 billion, and that's in one quarter, reflecting growth across both the products and services divisions. This was better than the markets expected. Operating expenses rose 18.9% to 12.6 billion, but despite this, operating profit rose to 30 billion from 27.5 billion. There was a 5% increase in the dividend, with a payment of 23 cents a share announced. The group also upped its share repurchase program by 90 billion.
Wow.
There has been a good response to the new products, according to management, and this fed into a 5.5% increase in iPhone sales to 50.6 billion. Mac sales grew 14.6% to 10.4 billion, although iPad sales fell 2% to 7.6 billion. Wearables, home and accessories rose by just under 1 billion to 8.8 billion. Services revenue rose just under 3 billion to 19.8 billion. There was growth in every geographic region except the rest of Asia Pacific. Apple's biggest market, the Americas, saw net sales of 40.9 billion, up 19.2%, while Europe was more tepid, rising 4.6% to 23.3 billion. Greater China revenues rose just over 615 million to 18.3 billion. Japanese performance was broadly flat. Apple had net debt of 61.5 billion at the end of March and free cash flow of 69.8 billion. The business trades at a P/E ratio of 24.5, and that compares to a 10-year average of 16.4. And the prospective yield over the next 12 months is 0.6%. And let's just have a look at the market cap as well, because that's always fun. Yeah, so it currently trades at a market cap of $2.55 trillion.
Wow.
So yeah, these are fantastic results. I know some of the figures aren't, I mean, they're not as glamorous as some of the high growth stocks, but this is a business that is growing off such a large base, and it's doing it in an environment where people talk about supply chain issues. You know, people have been talking about it for the last year or so now. You look at the Apple results and you just think, what supply chain issues? I suppose if Apple places an order, you make sure you deliver on it, but it's just absolutely insane for a business of this size to carry on with these growth figures. It's just absolutely, I just think it's incredible. I am in awe of it, actually. The only thing is I just wouldn't pay 24.5 times earnings for it. I don't, it could prove me wrong, and it wouldn't surprise me if it did. I would be uncomfortable paying that. I think there's a lot of, you know, that you're baking in a lot of growth, and when it's off such a high base already, it's just, for me, it's too difficult to predict. What are your thoughts on these results and the valuation, John?
I mean, I think excellent results. It seems to just be, I don't know how it keeps churning out numbers like this. And I mean, what you're saying about sort of valuation, we would have said it when it had a market cap of sort of $1 trillion. You know, people,
how much bigger can it get?
How much? Well, exactly. And then it's, you know, more than doubled. So I think it is very, very difficult to say, I am an Apple fan, I own the products, and I really want to buy the products, and I'm willing to pay a lot for the product. And I think a lot of people, you know, obviously feel the same, and they're always attracting new customers as well. I don't think it is just, you know, an iPhone company. I think they've shown that it has broader appeal than just that. It's very difficult to say, would I buy shares? I don't have shares directly, but I've got a lot of money in sort of the World Index, which the largest company there is Apple. So I suppose indirectly through that, I do have it. A little bit like you, I haven't been brave enough to just buy shares in Apple, but I think it's a fantastic business, and probably will. Well, it's been on the watch list for a long time, and it'll continue to be there, I think.
Yeah, I mean, equally, whilst I wouldn't buy at these levels, if I had bought earlier on, I don't think I'd sell. I think it's too good a business. But
Yeah.
Buffett's quadrupled his money on Apple, I think.
Yeah.
When he bought it.
Yeah, well, I know. I remember when he bought. Yeah, I remember when he bought the shares. But what do you think of it compared with if you looked at the FANG stocks? Which would you? I mean, is it Meta for you or Facebook for you?
Yeah, well, I own Facebook.
Yeah,
We'll call it Facebook. It is called. It trades under Meta, but we'll call it Facebook.
Yeah.
That's basically what it is. I just think Facebook's probably. I mean, it's the smallest now, apart from Netflix. But it's the smallest by quite a bit now. I think it would have to like 5x to get to Apple's size. It's just the one I find easiest, where it's the valuation's probably the most reasonable. I think it's easier to try and predict where the sales are going to go with it, because you can almost use Google as a blueprint in that it can probably keep expanding the sales for a long, long time. And I just think I just find it much easier to look at it and say, well, for example, like with Facebook, it's like, well, I could see this being a $1 or $2 trillion business, and it's only $500 billion now. Whereas with Apple, I don't look at it and say, well, I can see this being a $5 trillion business. It wouldn't surprise me if it got there, but I feel like there's just probably more reward available in Facebook for the same amount, or maybe even less risk. But
okay. And what about sort of your Amazons? We covered Netflix recently.
I don't follow Amazon that much, to be honest. I'm not familiar with like how it's valued. I mean, it's obviously a very good business, but my understanding is that if you look at what Amazon Web Services would trade at, if it was listed on its own, it's actually quite a cheap business, especially when you include, I mean, the size of the ads business now in Amazon is just insane. And then you've got the retail as well, but it's just not a stock I really follow, to be honest. What about you if you had to pick a FANG stock?
I probably would go with Apple, although I appreciate your argument with Meta and Facebook as more commonly known, and certainly the valuation, because I often don't like to pay very high multiples, but quality like Apple, maybe it's just one that you should be comfortable doing that with. Yeah, difficult. Probably Apple.
Yeah, I mean, to be honest, any of those businesses. I mean, I'd sleep well if I had Google or Microsoft in my portfolio as well.
Yeah, absolutely.
So of the 6 businesses we've covered today, Associated British Foods, Whitbread, Unilever, Sainsburys, Reckitt Benckiser and Apple, if you had to buy one, which one would it be?
I would probably go with Unilever on the quality and valuation argument. What about you?
I'd probably go with Associated British Foods.
Okay. I can. That would be There, if well, a lot of good companies there actually. That
there are,
I
yeah.
consider,
and
I think especially whether there's been this, and Whitbread, when there's been a bit of a pullback too, it makes it a little bit more difficult, I think.
Yeah, there's a lot of options at the minute. Right. Well, I think that's everything then.
I think that is everything.
Right. Well, thank you very much for listening, and we'll see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.